Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed, and I'm a corporate and M&A attorney here as the host of SaaS Buyers Club, where our mission is to interview thought leaders to help founders get the best exit possible. And here's what I believe. I believe that anyone who comes on the show that's a thought leader that can share some value for the founders out there, no matter what the value is ultimately going to help founders get better exits, because the mission is we want the audience out there to get some value, go out there, be able to implement some things, maybe know some things, have some talking points, that sort of thing, so that they can build their businesses to get the greatest value when they exit possible. So with that being said, I'm really glad to welcome Logan Burchett from Forecaster. Did I say your last name right, Logan?
You absolutely did. And you're one of the few that do. So congratulations.
Awesome. I'll wear that hat today. And wear it proud. So Forecaster does financial projections for all kinds of startups, mostly SaaS, I believe. But I'll let you, talk about your own company.
Love it, man. Well, thanks so much for having me. First and foremost, I'm glad that we were able to make this happen. And I know that it's been a few weeks in scheduling, but I'm glad to be here and super pumped to talk a little bit about Forecaster. And you hit the nail on the head. So that's what we do. We do financial modeling, financial projections for startups primarily, but we can work with a bunch of different companies. So we really work with all kinds of private companies. Really, our target are companies that do between 1 and 10 million of revenue. We found that whenever you hit about $1 million in revenue, that's whenever things start to break in your startup. And up until that point, you can probably manage finances on your own okay. I wouldn't say you could do it great. Most people that aren't finance focused, they don't have a background in it, but you can get by with it. Once you get to around $1 million in revenue, that's whenever things start to get a lot more complex. And I like to say you have a quote unquote real business around that point. Not that you don't have a real business before then, of course, but that's whenever things start to feel more real. It feels bigger than you, and you start to have to take ownership of things that are perhaps unfamiliar to you, more ownership, I should say. So finance is certainly one of those things, and that's really where Forecaster comes in. That's really what we do. That's what we love to do, and that's who we serve, are those founders, entrepreneurs, operators that are in and around that 1 to 10 million. And we do work with a lot of SaaS companies. That's the average. If you're to look at all of our customers, most of them are SaaS, but we can work with all kinds of companies. We have e-commerce companies, we have hardware companies, we have consulting companies, pretty much you name it. We've probably worked with it. So glad to be here.
Yeah. So, it's kind of interesting. There's a bunch of coaches out there, law firm coaches at least, and they really burst my bubble around this. I think a lot of entrepreneurs really gun for that 1 million mark in their business. It represents some sort of a benchmark. And these coaches are stop being the quintessential entrepreneur that wants to make $1 million. But what I hear you saying is actually the $1 million mark is a significant threshold and an important threshold for business owners.
I'd say that there's nothing magic about the number 1 million. It's just kind of a nice round number that they're in and around that $1 million range. Maybe it's at 750,000, maybe it's at 1.2 or 1.3 million. It's different for different companies. But what has been clear to me over the past several years of being in this space is that there is some sort of a transition that happens around that time. You get to that amount of money. I mean, your $1 million is $86,666 a month. I mean, that's a lot of money that's running through your business. And if you're the founder, entrepreneur, you are in charge of that and you have to manage it. It's a lot easier to manage cash flow of a company doing $20,000 a month, recurring revenue, 30, 40, 50, up into that point. But once you kind of bump up and get up into the, call it higher 6 figures of monthly recurring revenue, it just gets harder. It gets more complex. There's just more things to have to pay attention to. So that's how I'd answer is $1 million's an arbitrary number, and there's nothing magic about the number 1 million. But I think that there is some kind of nice roundness to it that around that range is whenever people really start to have a hard time with this type of stuff.
Yeah. And of course, being able to say that, you make $1 million a year is always nice too, even if it's only your top line. So
exactly, man. And at some level, there is optics in startups, and it's just kind of a part of it. And that's true in life. We think about things in terms of tens, like just as a species, right? But there's nothing magic about the number 10. It was an arbitrary number that was just picked. And so I think a lot of people, they tend to operate around these magic numbers, the 1 million in revenue, the 10 million in revenue, the 100 million. They want to sell for 100 million. No, they want to sell for a billion, whatever it is. But it's just a number, it's just a number that people tend to rally behind. So it does inform behavior, I think.
But talk to me, about what happens around the $1 million mark that, breaks the way that the startup operates, that really requires the founder to have a stronghold on the finances such that they start seeking out solutions like yours. What happens around that time?
It's a great question. And there's a couple of things that happen, I would say. First and foremost, there's just cash flow considerations. And there's not a one thing that I can point to say, this is the thing that causes the domino to move. It's more of just the theme that $1 million in revenue is just a lot of money to flow through a business. So like very, very few people out there individually make $1 million a year personally, right? So this is a very atypical thing to be able to manage that type of money. But $100,000 a year, even $200,000, $300,000 a year. This is stuff that people can manage even personally on a personal level. So it's kind of like once you get very far outside of what you're comfortable with and what you're familiar with, you start to want to bring in more resources. You start to have to admit it's getting to a point where I'm making a lot of money. I'm also spending a lot of money. And there's an element of fear to it too that we've noticed, where when you have $1 million of revenue, we talked about the arbitrariness of the number, but people feel like I've got a grown-up business now that I'm at $1 million in revenue. I've made it to some level. And with that comes a burden of responsibility, or at least what they perceive as a burden of responsibility. And the thought process is, I have this asset that now has this tremendous value because I've exceeded this threshold that I've set for myself. Therefore, I must protect it. And a business is a lot of things. One of them is a money machine. I mean, that's really what it is. It's an asset that produces money that needs to be managed. And one method that founders use to protect that asset is just getting the right people in the room and making sure that they fully understand their cash flow, to make sure that they're managing it properly, and to make sure that the company doesn't die. Because I think we all know that it's one of the biggest killers of companies is just running out of cash. Top 3 reason that companies die. So it's an avoidable one. And that's really where we come in. So that's one. It's just the fact that more cash flow equals more problems or more things that they need to understand. And that's probably the biggest one. But the other one is around these venture funded companies, which we work with a lot. I mean, the majority of the companies that we work with are venture funded. Once you get to that $1 million threshold, expectations seem to get higher. It's kind of like whenever you raise a round and you raise a pre-seed round versus a seed round versus a series A, the types of questions and expectations that you get from an investor is very different at the pre-seed and seed round. You can get away with a lot of things in those early rounds that you can't get away with in the series A round. It's similar, I would say, whenever it comes to revenue distribution, where once you get to that $1 million revenue threshold, you start to investors have this expectation that you have things a bit more together, for lack of a better word. So what that means is proper forecasting. That means proper reporting. That means understanding cash flow, projecting cash flow, getting capital planning together to understand how you're going to be growing, or if you're going to be raising money, or if you need to take on debt, or whatever it is. So those are kind of the two barbell ends that I would say. It's just general cash flow management, needing somebody to help you with that and understand it, as well as pressure from investors to report to them. But then also, if you're raising money, to be able to communicate a plan, a financial plan for your company to potential investors. So those are kind of the two biggest ones, I would say.
And what do you typically see when people come to you in this kind of general vicinity of, $1 million ARR? Obviously, that's a benchmark for a lot of investors out there. A lot of investors really want to invest around the $1 million ARR benchmark, right? So that's like at that stage as well, right around the 1 million ARR stage is like when going into Series A territory, for example. And so the due diligence process is, going to be more scrupulous as opposed to, for example, going to an angel investor or a seed investor. And what I'd like from you here is to describe it in a way where maybe an audience member or a listener is like, oh, actually, that might be how I am, or that's my situation, for example. Like, what do you see with a lot of startups?
Depends on the startup. There's really two broad buckets, I would say, if I'm kind of like painting two broader buckets. It's you have the bootstrapped entrepreneurs and then you have the venture-backed entrepreneurs. The bootstrapped entrepreneurs are very interesting because once they get to a point where they feel like they have a company that's producing a lot of revenue, 1 million is kind of the threshold that we've set. Again, what I'm seeing is that they feel like they need help understanding what to do with the cash they're generating, but also understanding cash flow. So one thing that's very common that seems strange whenever you say it, but it is actually very common, is you'll have these companies that they're profitable on paper. These bootstrap companies are profitable. They're generating a lot of revenue, 1 million plus. And on the income statement, it shows, hey, we're making a profit. But for whatever reason, they're having issues with cash flow. Their bank balance, it always kind of stays the same or it grows very, very slowly. And they need help understanding why that is and getting a plan together to ensure that their bank account grows. So that's one thing, is like, what is happening to the cash I'm generating and how can I get a plan together to generate or capture more of that? Another one is, I don't know where to spend my money. I'm getting money, it's flowing through the business, and I'm just kind of spending it on things that I think I should be spending it on. But how much do I need to invest in marketing? How much money do I need to set aside for this or that? And just getting a plan together to kind of show where you need to be spending money or the best ways to spend money. Then the third one is, am I leaving money on the table, right? So if I do have a big bank balance, am I getting proper interest rates on the money that I'm holding? Could I get tax credits? Are there grants available? Things like that. So that's kind of the bootstrap founder. It's all around cash flow management, understanding cash flow management, anxiety around cash flow management. On the venture side, it really comes down to whether you're raising a round or whether you have raised a round. So one of the biggest pain points that we solve, I think the most severe pain point that we solve for a lot of founders, is around a fundraise where they're raising capital, they're pitching investors. And once you get to that $1 million mark, you might be flirting with the Series A round that you're raising. Scrutiny goes way up at a Series A. A big part of that scrutiny is going to be financial scrutiny. So people, by that point, you have real numbers. You should understand your unit economics very, very well at that point. You should be able to have a full understanding of how you're going to deploy the capital that you've raised. And being able to tell that story becomes very, very important. There's kind of like an analogy that I really like to use to describe different rounds of funding, where whenever you're a pre-seed round, you're really just kind of validating whether or not there's a problem worth solving. You're trying to understand, you're getting like problem market fit. Then during the seed round, you're starting to build out that economic model where you're seeing, can I get people to actually pay for what I'm doing, and like trying to get some semblance of product market fit during the seed. But then at the Series A, the expectation is the money machine has been built and now you must dump gas into it to make more money. So you want to be able to put in $1 and get 3 out. It's very important that you can tell that story and show financially how, if I get $10 million, 15 million, whatever it is, how can I deploy that in a way that's going to put the money machine to best use, right? So there's a lot of storytelling whenever it comes to fundraising and things like that. But generally, it's an interesting space to be in, because while customers might look very similar, there are a lot of pain points that good financial practices can solve. And so there's a great variant of the different things that customers come to us for. But generally, it comes down to cash flow management and fundraising and investor relations. Those are kind of the two big ones.
Cool. So one of the things that I heard you say is, on the bootstrap side, might be profitable, but they keep running into the bank balance being low. Talk to me a little bit more about that in terms of why does that happen?
Yeah, it's a good question. It can happen for a bunch of different reasons. One of them is just, especially for companies that aren't SaaS companies, it's inventory if you're e-commerce. And this is a really, really massive challenge for e-commerce companies where if you're going to sell something tomorrow, you have to buy it today. So you got to buy up inventory. You have to plan for that. You have to hold in reserves. You have to understand what you can afford to buy, therefore what you can afford to sell. And so that can be a very, very big one. We work with a lot of companies that they have a lot of debt. They're having to make those payments and perhaps they're paying more than they should be because they have a bad debt deal that they negotiated years ago that they're still dealing with. A big one is accounts receivable. There's some education that's needed to be done for a lot of these founders, but whenever you send an invoice and you, especially with enterprise SaaS, for example, you'll recognize that as revenue on the income statement, but you're not necessarily collecting that cash. And in some cases, you might not collect that cash for 30, 60, 90 days. So I see this all the time where you have these clients that are posting hundreds of thousands of dollars a month recurring revenue. But whenever you look at the statement of cash flows, they might be collecting $50,000, $60,000 a month. And it's because it's all sitting in accounts receivable because, they're maybe not as familiar with the financial statements and the applications of that. They look at the income statement and they see, I'm doing 20, 30% net margins. I'm profitable. But what's happening to my bank account? Nothing's happening. I'm not getting, paid on anything. So there are things that you can do to help mitigate that. I mean, there's AR factoring. You can negotiate with your vendors. There's all kinds of stuff that you can do. But there's a bunch of little things like that that can lead to you not having as much cash flow as you think, that you should have.
Yeah, that's a great answer. Thank you for that. And I was totally going to say, yeah, I mean, it might be as simple as, in the contract negotiations, for example, reducing the amount of time that the invoices get paid, for example, instead of net 60, for example, net 30, net 15, whatever it might be. Oftentimes, even with those contract terms, other companies may pay late. So maybe instituting a practice of having your AR department or whoever the person maybe, staying on top of it and making sure to, follow up with the outstanding invoices to make sure that they get paid on time, for example, to reduce the amount of time that it takes to collect the cash. So these might be some of the practices that people could utilize to address the bank balance being low where that's the case.
There's a lot of stuff like that, man. And then incentivizing people for paying early. I mean, there's a lot of incentives that you can put into place to help with that. I'll tell you another big one that I've seen a lot too that I didn't mention is annual contracts whenever it comes to SaaS companies. So you'll see companies that rightfully so, they push for these annual payments. So they get all the cash up front. But then if you're doing accrual-based accounting, you recognize that revenue on the income statement for the next 12 months. So if I have a big contract and somebody pays me $100,000 for the entire year and they pay up front, I'm recognizing that revenue over the full 12 months. So that's an instance where I have the cash. In some cases, I've already spent that cash, but on the income statement, I've still got the revenue from that contract that's being played out every single month. So there's just a bunch of little nuancy situations like that. But it's just interesting because at the end of the day, cash is king. There's a saying in finance, profit is a matter of opinion, cash is a matter of fact. Depending on how you look at your financial statements, it could lead you into a false sense of security where you believe that you should be collecting this much cash when in fact maybe you shouldn't be, or maybe you should be, and you have a hole in your business somewhere that you need somebody to help you figure out. So there's just a bunch of stuff like that. And again, all of this stuff, and this maybe if you're listening, it becomes a little bit more obvious why around $1 million things start to break. It's when you got a couple clients, maybe if you have a smaller price point, a couple hundred or maybe a low thousands or whatever, it's manageable. But once you get to that point where you've got $1 million or millions of dollars running through your business, there's all kinds of little intricacies like that aren't obvious if you're not classically trained in finance. And that's really where we come in, is we know this stuff. We've seen it all at this point. So we can kind of use our knowledge and what we've learned to help you understand your own business.
I think this probably doesn't even need to be said, but until you have it all mapped out, it's hard to see where, you're bleeding, for example, or where the cash is going. And, that's why it's so important to get these things in place. When people come to you, how are they currently Is it that they aren't tracking? Do they just look at their bank balance? Like, are they putting spreadsheets together? What are people usually doing?
Usually it's one of a couple of things. Usually it's a hacked together Excel sheet that is getting unwieldy, that is either way too complex or way too simple. You know what I mean? It's like something that's untenable and not very useful to them. So like we see that a lot, just kind of a homegrown Excel spreadsheet. We see what you're talking about, where you just get in and you look at your bank account every month and you try to guess what's going on. We see that. Then we just see people that don't do anything. There's always this feeling, there's this very common feeling that I get from all the customers that we have, where they realize that they should be doing something here. Like, if that makes sense. Like I don't quite know what this is, but I know that this company is getting big enough. And now I'm recognizing that I need a pro to help me with this. So that's really the hook, I would say, is like where people come in. But what we do is a lot bigger than just that too. So, one of the frameworks that I walk through with a lot of clients is working backwards from the goal that you have for your business. So that's, to me, how financial models are so powerful. If you say, for example, that you want to sell your company for $100 million in 5 years, right? Let's say that that's the goal that a founder has. Well, we can take that goal and then we can work backwards from that goal to understand exactly what needs to happen every single month, and even down to the day if we really wanted to, in order to hit that goal. So just to run through the exercise with you, it's like, if you're a SaaS business, you want to sell for 100 million. Okay, cool. Let's assume you get a 10x revenue multiple. That means $10 million of revenue in 5 years. Well, let's say that you're at $1 million right now. So that means you have to add $9 million of revenue over the next 5 years. So you can break that out. And then you can see, all right, well, how much revenue do I need to add every month? Okay, cool. Now I can understand how much the average customer pays me. So I can break that down into how many customers do I need to get per month. If I'm a SaaS business, I have a churn rate. I know what my churn rate is. So I can look at, on average, how long they stay with me and how I can stack those up. So when it's done right, and then also I can break down, I know how I'm getting customers today. So if I'm getting them from webinars, if I'm getting them from paid ads, if I'm getting them from SDRs and the sales team, whatever it is, I can break that down and say, this one SDR can get me 5 customers this month. These paid ads can get me this many customers. And then what you can do is you can identify the constraints and you can figure out what would need to be true for you to hit that goal on any given month. So I think that one of the reasons, especially for startups, that forecasting gets a bad rap is that people think, my business is so unpredictable. It's so small. It's all over the place. Like, if I'm IBM, sure, it's easy to forecast. I'll just grow everything by 2% a month or whatever it is, right? Because I have the data to show exactly what that is. But if I'm a startup, I don't have that data. I don't have that luxury. So it's a waste of time. But that's not what forecasting is all about. Forecasting is about working backwards from an outcome that you have, right? Working backwards from a goal and understanding what you need to do in order to achieve that goal. So I like to refer to it, we call it financial models, obviously, but a lot of times I refer to it as a financial roadmap, right? It's like, what is the thing that I need to do? And if I'm to achieve this goal, right, I need to chop up the steak and I need to understand there are things that I need to do, steps that I need to do along that path to get to that goal. What are they, right? And crystallize the vision so that you yourself understand what needs to happen. Then you share that with the team so they understand, and you can add ownership, apply ownership to it. And then you share it with investors so everybody is in full alignment what the goal is for the company and where you're steering things. So that's like the ultimate, I would say, outcome of working with Forecaster.
Yeah. And I would summarize it as, what isn't measured can't be managed.
Yeah.
That's the saying. And that was actually a really great framework, very clear framework, broken down in terms of, we all hear about startup founders that want the $100 million exit. So if you want the $100 million exit, that's how you can achieve the $100 million exit. Obviously, there's a lot that goes into there, but I think the way that you broke it down in terms of even being super clear in terms of, tracking the metrics of this SDR, acquires this many customers, Now you just got to ramp it up in that way because, this is achieving you this. So if you want to hit this, then, you need to tweak these things. And yeah, man, that's great. So the other thing that I heard you say is one of the benefits, the financial models is identifying where money is being left on the table. Can you give some examples of places where founders leave money on the table?
Big one is just their own bank accounts. So we'll see this a lot, especially with venture-backed companies. Let's say I go and raise $10 million. Let's say I have a big round. What most people will do, rightfully so, is they'll put it in their bank account, but they'll do it just like they would with their personal accounts. And they'll have like a checking account and they'll use that as the operating account, and then they'll run the business out of that. The problem with that is that you're getting the same interest rate that you might get on a personal account, even though you have $10 million in that. So one of the lowest hanging fruit things that we like to do with our companies is set up a sweep account. So what a sweep account is, it's a holding account that gets you significantly higher interest rates. And it depends on what the economy is doing at that point in time. But the sweep account that we have at Forecaster that we use, I think we get around 5% on, which is real money, by the way. We get $10,000 a month of just interest, right? Because of the money that we have in that account. But what it does is you have some threshold where it will keep the vast majority of the funds into the sweep account, but then it'll put it in your operating account only when you need it. So you're able to generate significantly more interest. That is one way that, we tell some clients, like, we could probably pay for ourselves just through us finding strategies like that to get you more money. But that's a big one. And that's a really important one, I think, for venture-backed companies that, in my experience, very few proactively do. They just don't know about it, right? So that's one. Another one is just like R&D tax credits, right? And employee tax credits and things like that, where there's a lot of companies out there, like Main Street is a good example of this, where you can apply for these tax credits and they can be pretty immense sometimes. These can be really big tax credits where we've had clients, I think, get back $50,000, $60,000, $70,000 in tax credits just by applying for them. And it's very simple to do. There are companies out there that'll do it for you. And we, Forecaster, we don't ourselves do it. We just refer them to some partners that we have. But that's another area where you might get, a couple of tens of thousands, if not hundreds of thousands of dollars back. And it's no risk, right? It's just sitting there. You just have to do the work and get that money back. So those are two really strong examples. And then I would say a softer example of it would be just grants that are left on the table. Like, there's a lot of grants that are going on that are available for companies that are smaller, but are growing very quickly. And these are non-dilutive. You just have to fill out some forms and things like that. So there have been instances where we've kind of taken that on for a few clients as well. There's a bunch of little things like that they can add up and they can really significantly add to cash flow.
Yeah, that was great. That the high interest count, I think you painted the picture really well there in terms of how much money is being left on the table with such a simple solution. Yeah. And as part of that solution, a very specific place that people can go to get the solution itself. So that's cool. Anything else that you want to share here or?
No, well, there's, I guess, one clarifying point that I'll put on the sweep account is if you want a very easy hack to get this done for yourself, just ask whatever bank that you're currently using right now if they have a sweep account program or if there's any availability for you to get higher interest on your money. Most of them have this. Most banks will have this as a product that they offer. They just don't really tell you about it. That's what happened even at Forecaster, right? We bank with PNC, and whenever we set up our account, we didn't have a sweep account. We had to ask our administrator if they had one, and then they put it together for us. So if you haven't done that, that's a really quick way to maybe get some more cash in the door. If your bank doesn't have that, there are other third-party providers that'll let you do something like that. There's a few. You can just Google sweep accounts for startups, and you'll get a handful of them that'll pop up. So it's a good way to do it. I'll maybe throw in one more really quick.
Yeah, please.
This is less of leaving money on the table, but it is something that we do a lot at Forecaster, and I think it's kind of leaving money on the table. It's basically the notion of interest rate arbitrage for a lot of SaaS companies, where and this only works if you have a very predictable money machine, like I said. So if I know that if I spend $100 on paid ads, I will get $300 back under this amount of time, and I've got good, strong data, very predictable data to get that, then we highly recommend that you take a look at debt. because that is a great way to just finance the growth of your company almost risk-free if the data supports it. Because even if you have a high interest rate loan, right? Let's say it's for startup, if you're an unprofitable startup, high interest rate could mean 15, 20%, or maybe even higher. Right? If you're a bootstrapped company and you've got some data, you're probably going to get a little bit lower than that, but it still might even be in the flirting with the teens, like 10, whatever. But if you're getting a 3x LTV to CAC ratio, right? So if your customers are worth 3 times what it costs you to pay them, it doesn't matter. You're going to beat that interest rate into the ground, right? Like, I mean, you're going to absolutely demolish that interest rate, no matter what it is. You're going to be growing more than that interest rate is, probably, if the economics hold up. So if you get $500,000 of debt and you pour all of it into that predictable growth channel, then what you've done is you have arbitraged an interest rate. Somebody has given you money at one rate. You have then invested that money into your business and got a much higher rate on that money. I keep the difference, right? And the good thing about that is, like, when you do that, you can just pay the debt back, and then you can rinse and repeat. You can go again and again and again and again. If you've got that predictable growth engine, which is not easy to build, but if you've got it, then you can scale up very quickly and you don't have to raise any equity. You can just keep doing that, and then the business pays for itself. So that's another one framework that we like to use. And that's the thing, is like, sometimes, just unlocking one little thing like that and getting that into a founder's mind. I mean, like, that could save somebody a ton of money, but then also a good chunk of their company if they were going to go raise, let's say, a big Series A and give up 20%, 25% with options, 20-30% with options. Like, maybe just get debt instead and keep all that, right? So it can be a big unlock.
Yeah. I'm curious, is it just lack of knowledge that makes founders not pursue that? Because I would imagine, like, if you have a dialed in money machine like that, where you can, substantially multiply any dollar invested in acquisition of a new customer, it's a no brainer. Just go get a bunch of money and like pour it into your company and go acquire more customers. What do you think it is that keeps founders from utilizing that?
It's a lack of knowledge. It's a lack of understanding. I mean, there's so many companies out there that you have founders that, I don't want to cheapen what they've done because it's incredibly impressive, but it almost seems like they've fallen backwards into a company that's doing incredibly well. Like, you know what I mean? Like they're like, I stumbled upon this niche. I built this software, what have you. All of a sudden, maybe it takes them a couple of years, but I'm generating $100,000 of revenue and I own 100% of the business. And I'm just on this treadmill trying to keep up, right? I'm just trying to keep the thing alive. It's that they've never educated themselves to understand all. I mean, the breadth of the knowledge that you need to run a good business is very, very vast. So it's not shocking to see that this is something that maybe is not fully understood by most people. But I think that there is this lack of understanding from a lot of founders and just lack of knowledge of what's out there. And pair that with this kind of treadmill mentality of, I don't have time to look up and think strategically, especially from a financial perspective, about my business, because I'm just trying to fulfill these orders or get this customer what they need on time or what have you. Sometimes just paying an expert that can look at your business from, above impartially and just point things like this out, because we see it's very obvious to us, right? We've done this for so long. I mean, this has been my life for 10 years now. And so I know all the tricks. It is going to be pretty hard to surprise me at this point. But if you're a founder that's been heads down focusing on your company and just growing, it'd be almost unreasonable for them to have the same level of knowledge that I do and my team does, right? So it's lack of knowledge, but it's not like a bad lack of knowledge or a shameful lack of knowledge. I would say it's just a inherent lack of knowledge, in the same way that I might have a lack of knowledge of how to build that software in the first place, because that's not what I do, right? That's not where I
or sell it to customers or whatever,
or put legal structurings around an acquisition, which is something that you would be very knowledgeable on, and I wouldn't, right? So it's just, everybody has their circle of genius. And I always like to find, whenever I have a hard problem that I'm looking to solve that is outside of my circle of genius, the first thing that I do is I find somebody that is their circle of genius. And I try to either learn from them as much as I can or work with them and solve my problem outright. And I think that that's the space that we play in, is like, this is our circle of genius. This is really where we shine. And we just stick to that. We try to provide as much value as we can.
Outside of that circle of genius, you find the right advisors to work with that, have the knowledge and the answers and the experience to help cross the different thresholds that the business goes through. I'd love to talk about storytelling. What are some keys to storytelling that you can share for founders with respect to financial storytelling?
It's great question. I like to explain financial modeling to this, financial road mapping, whatever term you want to use, forecasting, however you want to term that. But this is especially important, I think, in a fundraising environment or acquisition or what have you, whenever there's a transaction that's on the table. Everybody's familiar with the pitch deck, right? Everybody knows to put together a slide that describes what their business is doing and the future of their business and things like that. Well, a financial model is the numerical version of your pitch deck. And the way that I like to explain it, they are telling the same story. They must tell the same story. One tells that story in English, the other one tells it in French, right? Two different languages, same story. But here's the thing. Whenever you talk to investors, acquirers, whoever, right? Whoever's listening to it, some people speak better English than they do French, and some people speak better French than they do English, right? And if you look at the audience, especially with VCs, and you look at their backgrounds, then I think you'll notice most of the time, not to generalize, but most of the time, they will have a bias towards metrics and numbers and finance. A lot of them come from investment banking backgrounds. A lot of them come from private equity backgrounds. A lot of them were ex-operators, successful startup founders and in their own right. They will resonate a lot with the numbers. And that's how they like to evaluate businesses a lot of the time. So if you have a financial model, projections, whatever, that tell one story, but what's coming out of your mouth is totally different, and what's in your pitch deck is totally different, they're going to pick up on that. And they're going to say, there's something off here, right? And I see this all the time, especially with earlier stage founders, where they just sleep on the financial model. They almost treat it as homework. Like, I'll check this box and I'll pay some consultant to go and put something together that makes some amount of sense, and that'll be that, right? But they get into trouble whenever it comes under heavy scrutiny, and somebody that speaks really good French, to go back to that analogy, is looking at it, and they're like, I'm using this to evaluate the entire business right now. And if you haven't given it the respect that it deserves, you can come into a lot of problems, right? So that's the way that I like to explain it, is you are telling a story with numbers, with your projections, with your financial model. You are explaining, in a lot of ways, it's the most intimate level of scrutiny that you're going to get on your business, because your financial model shows investors how you're going to turn their dollars into more dollars. That's what it does. It shows, give me this amount of money, and this is the amount of money that we expect to return. That's what it does, right? So investors, the right investors will take tremendous interest in it. Shortchanging it, not spending a lot of time on it, it's not something that we generally recommend. We recommend giving it similar level of attention that you might give your pitch deck.
And so what are some of the things that you see with a lot of startups with respect to, like, once you put the financial model together, like, what are typical problems that you see for a lot of startups? Like, is it high burn rate, for example? Like, what is it really that you're seeing out there?
This is especially true with really early companies. It's projections that make absolutely no sense whatsoever. So, like, I'll tell you a couple stories. One time, a founder sent me a financial model to review, and he was projecting, he had no revenue today. It was an idea that in 3 years, he was going to be making like $90 trillion of revenue, right? At like 99% net margins. And he bold-faced, sent this to me and was like, yeah, I mean, I think that these are legit and reasonable or whatever. And look, nobody expects you to have a full understanding of what your revenue is going to look like in 3 years whenever you're just getting started. But what that is it's a tell. Because this man has just shown me his hand. He's just shown me that he doesn't know what he's talking about. And he didn't call out that he didn't know what he was talking about. He actually puffed his chest out and said, this is exactly what I think is going to happen, and I will not back down from this. And so there is a bit of a tell that's like, it helps you suss out how legit is this founder and how honest is this founder, right? So there's an element of just completely incorrect projections that just show, that the founder doesn't know what they're talking about. But then there's also issues with how you project. So a very common thing that we see that I'm sure you've heard all the time is like, if we can just get 1% of the shoe market, then we will be, and it's only
top
1%. It's
yeah.
only 1%. Look at how small that number is. Like, and you know that, but here's the deal. Getting 1% of a massive market is incredibly difficult. Like that is like an undertaking that is tremendous, right? So one of the big issues that we'll see is what's known as top-down financial modeling, which is where you do that. You put in a big TAM, and then you say, I'm going to get 1% of that TAM, and that's my revenue. And magically, it's a big number because a big number times a small number is still a big number, right? That doesn't tell me anything. That just tells me that you know that a big number times a small number equals a big number, right? So it's the better way to do it, and how we coach our founders to do it is bottoms-up financial modeling. So you want to identify specifically how you're going to be getting to that outcome. So what are the things you're going to be doing? Who are you going to be hiring? How are you going to be spending your money? Are you going to be doing paid ads? Are you going to be doing this? You know what I mean? Identify the behaviors that are going to lead to the outcome. And that's how you build your projection. That's how you tell your story. Otherwise, the story is not really giving you a lot of interesting information.
One of the last questions here. What are you seeing out there in the market with respect to what VCs like to say? So at one point, you know, VCs were saying, we don't like to invest, or people are, you know, paying their salaries, for example. That's what VCs were saying for a long period of time. We don't want to invest so that the money is being used towards you being able to make your livelihood. For another period of time, I've also heard VCs saying, we don't like to necessarily invest for just sheer customer acquisition, for example. We don't want to invest for marketing dollars, for example. But in this top-down methodology, what recommendations do you have in terms of where people should be spending their time in terms of identifying the places that they should allocate their money?
It's a really, really good question. And I would say like, it depends on the stage that you're in. Somewhat of a red flag is if I'm a pre-seed startup and I'm asking for money and I'm dumping all of the money into marketing. Right. Well, if you're pre-seed, you're in kind of product validation phase. You're still trying to figure out if you have product market fit. So I would have expected a lot of that money to go into R&D or paying for developers or building technology when you're in that early stage, right? On the other side, if I'm a Series A company and I'm raising a Series A and I'm like, I want to raise $10 million to hire a team of developers, that can also be a mismatch of expectations because, well, at that stage, you should probably be scaling. You're going to try to triple your revenue in a year, let's say, or whatever that is. I mean, you need to be on that venture funding track. So I'd say it's stage specific. It really just depends on the company that you're in and just being able to make sure that you're telling the story that aligns with where you are as a company. But I will say one more observation, since we're talking about recent market trends that I've noticed that could be helpful, is I'm noticing that a lot of investors right now are putting an emphasis on being profitable and getting to cash flow positive. Right. Not all of them, of course, but it's noticeable to me. I've noticed that a lot of VCs that are pushing their portfolio companies towards profitability and getting to a baseline that they can sustain themselves. I have to suspect that comes out of we're still dealing with some of the turbulence from the SVB crash. It is something worth noting that's becoming valued in the marketplace and something that I've seen. So
awesome, man. Thanks for those insights and thanks for coming on and sharing all this value. You know, you're situated in a way where you see a lot of startups. You kind of get to look under the hood and follow their journeys in terms of fundraising and so on and so forth. So yeah, thanks so much, Logan, for joining.
Absolutely, man. Well, thanks so much for having me, Omeed. It's been a blast and happy to be back on whenever you want me.
Awesome. And for everyone out there, make sure you follow, you subscribe, like, comment, leave us a review, all that good stuff. Reach out. Logan's contact information will be in the show notes below, so you'll be able to reach out to him that way. I'm sure he'd love to hear from you as well. And as always, thanks for joining us and see you next week.